Hello and welcome to United's first quarter 2022 investment call. I'm Tom Healy, Chief Portfolio Strategist. With me today is Matt DeLorenzo, our Chief Investment Officer. He's going to give us an update on things like Fed policy, interest rates, and inflation. And for the first time, we have Jiorden Sanchez with us. He's an equity portfolio manager. He joined us in 2020 from Goldman Sachs. He's got an MBA from NYU and a CFA, so he's been a real great addition to the equity team. Before we get into 2022, I thought I'd give a quick recap of what happened in 2021. Obviously, a very strong year for equity market returns, with the S&P up 29% on a total return basis. That includes dividends. That's led by growth, which was up 32%. But unlike 2020, where it was a very narrow group of stocks that were up, it was much more broad-based in 2021. Value stocks were up 25%, small cap stocks were up 27%, and mid cap stocks were up 24%. So U.S. stocks in general did very well, and that was on the basis of accommodative Fed policy, significant stimulus from the U.S. government, and also a recovering economy which led to strong corporate earnings growth. That didn't translate into international stocks as well. Developed Europe was up 12% in 2021, and emerging market stocks were actually down 2.2%. So when we take that across into the other asset classes, fixed income was down about 1.5%, looking at the U.S. Ag Bond Index. Despite that, Matt and his team were able to generate positive returns in most of our bond strategies through our active management. So last year was definitely a strong year overall. The question is, will that continue in 2022? And are we looking at a bubble in terms of valuation? So I'm going to start out by turning it over to Jiorden to discuss valuation.
Thanks. Yes, so after a number of strong years, we have been getting a lot of incoming calls from clients on valuation. So I thought it would be helpful to address that here. And I'd like to do so in two ways. One, by just talking about what happened last year, and two, by providing some historical context. So yes, last year was a very strong year. The markets were up approximately 28% or so. And that was largely driven by strong fundamentals. Earnings per share was up approximately 35% for the year, benefiting from an economy that was reopening after the pandemic. And partially offsetting that was a decline in the valuation multiples of approximately 8% or so. So the point here really is that while the market did very well last year, it was primarily a function of strong fundamentals, and valuations are actually cheaper now than they were a year ago. I'd also like to touch on, a bit more of a longer-term sort of historical perspective. And as of right now, the market's currently trading at a 20 times price-to-earnings multiple. That's a bit more expensive than it's been historically, about 17 times, but it's not like we're yet at the bubble territory. And a good comparison for that is the tech bubble in 2000, where the market, was as high as a 25 times multiple. Another thing to note here is just, the environment that we're in. Interest rates are relatively low, and for that reason, equity valuations look comparatively attractive. And a good way to look at that is to compare the current earnings yield, which is approximately 5% to of the equity market, to the 10-year Treasury, which is approximately 1.8%. Just looking back at the last time we were talking about bubble territory valuations during the tech bubble, at that point in time, the earnings yield was more like 4%, and 10-year Treasury yields were higher at about 6%. So it really does show that, from a historical perspective, especially given the interest rate environment, valuations aren't that aggressive right now.
Great. So a lot of that discussion was around interest rates. So obviously, as we look to 2022, obviously, we're going to want to know what the Fed is going to do and how that's going to play out. So I'm going to turn it to Matt to discuss.
Yeah, absolutely. So it's really no surprise to anyone to hear us say that inflation is running a little bit high. The most recent CPI year-over-year print came in at 7%. So it's definitely been concerning to consumers. Investors are looking at it too. But the biggest thing for me when I think about inflation is how is the Fed going to respond? And that has implications for interest rates and spreads and equities and things like that. So really, what the Fed has said they're going to do is they've committed to winding down their QE, their bond purchase program, also called tapering. They've basically committed to ending that beginning in March. So there's a chance that may be accelerated too, but basically that program is going to be ending in March. And in addition to that, they're projecting that they will hike interest rates in 2022. So the market and the Fed aren't exactly on the same page with exactly how many interest rates are priced in, but we really are looking at a little bit of a changing landscape with the Fed, where they're going from a strong easing to actually moving over to a tightening. And for me, looking at bonds, the question becomes how much of that is priced in, and it appears certain areas of the bond market have made some attempt to price it in, but those are the things that we're looking at and considering when we're managing the bond portfolios.
Great, thanks. And so, Matt gave us his perspective on bonds. What does rising rates mean for equities?
Sure. So obviously there is an impact there. Year to date, you've seen a nice move up in bond yields and treasury yields, and that has had a bit of an impact on stocks as it relates to some of the volatility we've seen so far this year. And I'd like to discuss that volatility in two ways. The first is just generally what changes or swift changes in rates mean for equity market volatility. And then the second is where you end up seeing some of that impact within the equity market. So as it relates to swift changes in interest rates, we have historically seen that swift changes, especially over a short time period, can drive some equity market volatility, and so that's not necessarily surprising as it relates to what we've seen so far this year. We've also seen, as it relates to different equities within the equity market, there are certain stocks that react more sensitively to interest rate changes than others. And it's largely the ones that are of higher valuation. So growth stocks obviously trade at higher valuations than value stocks. And so far this year, a lot of that equity pressure has been in the subset of stocks that are a bit more growth oriented, with value stocks being a bit more flat to stable.
Great. All right. Well, we don't want to give you too much more detail, but I would summarize it by saying our expectation is this year we're going to see more volatility. For example, last year in 2021, the max drawdown, meaning top to bottom in a short period of time for the equity market, was only 5.3%. We would anticipate more volatility this year as rates start to move up. And it's also another thing we would add is it's a midterm election year. And over the presidential cycle, the 4-year cycle, historically, the second year, which is this year, tends to be most volatile. So we would expect, again, more volatility this year. But underlying that is the fact that the economy is still growing. We think that underpins corporate earnings growth. We expect earnings growth this year, which will also help the equity market. And so our expectation is that we'll see things move higher, but in a more volatile way. And then again, that benefits our clients in that we're active managers. So we're taking effectively active management moves in order to work around this type of volatility. So you'll hear much more from us in the coming weeks and quarters about things like the midterm election as we get closer and what that might mean, and also continued updates on things like the economy, corporate earnings, and Fed policy. So with that, I'd like to thank you for your time, and we continue to value you being a client. Thank you.